policy. So rating factors, how do you rate these wells? Obviously the assured's loss record, I mean, if they're a good prudent operator that haven't had too many incidents or anything, obviously if you have few claims, then you're gonna get a lower premium. The well locations and AFEs, the authorized for expenditure cost of drilling, if the well is located somewhere benign and there's good information about the well, wells available there, then underwriters will look at that in consideration. So it has a huge bearing. Obviously the AFE, if it's a large AFE, the underwriters are going to be curious as to why that may well be, what are the reasons behind it. It also has a bearing, obviously, the AFE on how you establish your limits for the policy. There's a rule of thumb that Cliff will poo-poo here, but generally speaking, for many years, what they were saying was that if you take the AFE and you multiply it by 3.5 times, then that should be a sufficient limit to buy for your cover. And I kind of agree with him. It's quite nonsensical. There's lots of other variables involved that make it more relevant to actually establish an AFE. But again, this is basically a standard sort of view on how it is. I mean, each one's treated differently. So what's the experience of the area? Is it difficult geology? Is there high temperature, high pressure? If you got a lot of H2S, is there CO2? Offset data is really important. I mean, offset data, what that is basically is if you're drilling in an area and there's been lots of other wells drilled nearby, then basically there's good information around. And quite often they share this information, and even if they don't, if there hasn't been an incident, then underwriters are comfortable that there's a lot of knowledge about that particular area that you're drilling in. So offset data is really quite an important feature. Again, are there specialist drilling techniques going to be used? Are you going to be doing managed pressure drilling, which it's quite a complex format, which if you talk to Weatherford and people like that, they'll say it's nice and easy, but we know that it's not. It can be quite challenging. It can be quite expensive. There's been situations where rigs have actually lost all their power from the MPD type techniques, and there has been a number of incidents with it. It's improved the ability to sort of successfully drill wells massively, but again, it's something that the underwriters might want to view with an additional premium consideration. Also, you've got your over and under balanced wells as well. So there's a well questionnaire that we have compiled, which is quite detailed, and I have it on a thumb drive, which I could maybe show you if time permitting. And it gives you a little bit of an idea of the kind of information that underwriters like to see in order to sort of ascertain the risk. Again, so what are the rating factors? Well, onshore is obviously going to be cheaper than offshore. It's just easier to control the situation. You've got the well control, and the whole demob and mobilization aspect is generally a lot cheaper. I mean, unless you're going to drill, we did some wells in the middle of the Amazon, in the Peru Amazon, and the AFE for that was very, very large. But when you saw the breakdown for the AFE, it was primarily the mobilization and demobilization costs, which actually made the AFE quite significant, as well as the logistics involved. The actual well itself wasn't anything too complicated. So it's a good idea to get the breakdown of the AFEs so that you can actually work out a number of things. You may not need to do your limit that high because of a high AFE, depending on what actually is the makeup of the AFE. So that helps quite a lot on the rating issues. So what else we do for rating factors? Well, this is a sort of descending order of generally how, and things can go wrong from this, but generally speaking, an exploration well will attract the highest rate, followed by an appraisal well, followed by development, workover, producing and injection and infill type wells. And then you got your shut-in wells and plugged and abandoned. I didn't put suspended in there, I forgot. Suspended wells are interesting. They quite often are associated with shut-in, but at the same time, I personally think there should be more in producing, because generally a shut-in well just means that you're going to come back. You haven't got the infrastructure in place yet to actually bring it online as a producing well. So in many ways, when it does come back online again, it should attract a rate at least as well along with producing. But quite often they do go on shut-in. I mean, as I said, this is not a science, it's a bit of an art. And there's lots of variables involved, and it's really all about what you can negotiate, quite frankly. Other bearings for the rating is the well depths and the total gross footages of all wells. If you have a large sort of portfolio of wells and footages, then obviously, you know, you can attract a lower premium. And also they've got, as far as the depths are concerned, I mean, the deeper the well, there's potentially more challenging areas that are there. I mean, and it's just not well depth, it's also water depth as well in there. The other factors is the limits that you want to purchase and the deductibles. If you come in with, say, a minimum offshore deductible is generally $1 million. But if you come in with, say, saying, oh, maybe we'll do $5 million, then the underwriters will give you a credit for that basis, obviously, because you're taking more of the risk. And then the other factor will be the number of additional coverages that you purchase on top of that, and we'll elaborate a little bit more on additional coverages. Okay, so there's a guideline in place. I'm smiling only because it's older than I am almost, and it's been around for a long time. But it is really just a guideline. But it's called the Addendum 44, and it's been around since 1960, and it's quite an interesting sort of document. I mean, and literally people are using it to this day still. I haven't got a copy of it here, unfortunately, but my copy is a little bit sort of ratty. But it's broken down into 5 areas. So you've got your Area 1, which is low pressure USA, Canada, excluding the Gulf Coast and the Rockies. The Rockies in Alberta and all the way down to Montana and all that, in Colorado, they have some pretty challenging drilling in there. They have a lot of sour gas. And they have a lot of wells that are quite deep that you have to drill with diesel-based mud like Invermol and stuff like that. And you could spend 6-7 months to drill a well that's 17,000 feet. That it's not really fast drilling in a lot of those areas. It is quite challenging. And for those old enough to remember Red Adair, he used to go to Alberta quite a lot in the 60s and 70s because they had a number of situations of blowouts there. So that is not included into that category. So where is it included in? Well, it's included basically in Area 2, which is all other land areas of the world. Area 3 is offshore Gulf of Mexico. Area 4, all other offshore areas other than 5, which is north of the Arctic and south of Antarctic circles. So most of the wells that you'll see will be Area 2 and Area 4, which is generally what we work on. They also have various depth bands, which personally I don't adhere to, but I mean, that's what they have stated in their Addendum 44. So you've got your 0 to 5,000 feet, 5,001 feet to 7,000 feet, 7,500 to 10, and so as it lists down there. And they do the base rates from these areas in association with the areas. So like for a $5 million limit, basically, the Area 1 that we showed you before would have, say, an agreed amount of, say, 56 cents per foot drilled. Everything's pretty much done you gathered in feet and in dollars here. I mean, it was a U.S. sort of design kind of program back then. And the oil industry still runs pretty much in feet. They do some of them in meters. The French do meters, and sometimes the Australians do it in meters. But generally speaking, they all talk in feet. Area 2, again, would have a base rate of $1.40 per foot drilled. Area 3, $2.81, and Area 4, $3.75. And those are your sort of limit base rates for a certain limit of, say, $5 million. Then they load up there in relation to what limit you may want to buy. And I'll talk about that more. And then you add on to the additional coverages. So it's basically just going from a number, and then you just increase it depending on how much limit you want to buy and how much cover you want to buy. So the rating options for unlimited and limited redrill, basically they range between sort of 45% load for unlimited redrill, and for limited redrill, it's a 30% load. The difference between unlimited and limited is basically limited redrill will give you a recovery of about, say, 130% of what your well was going to cost to drill. So if it was $1, then you get back 130, or $1.30, sorry. Whereas unlimited is unlimited up to the combined single limit that applies to the actual policy. This is, control of well is a funny sort of subject matter. I mean, it really, because it's non-asset based, it has a lot of different things associated with it. Seepage and pollution, generally what you would do for seepage and pollution, offshore would be 50% load, and onshore would be 33% load. Care, custody, and control, as per the addenda, attracts a load of 15%. And then underground blowout for onshore would be 25%, and for offshore would be 35%. Now, these are guidelines. You can negotiate whatever you want with these. You can actually not even sit there and do the whole calculation. You can just go and say to the underwriter, I want all these coverages, and just negotiate with the rate. But it's just showing you that there is a mechanism in place. Footage credits, again, so if you have a million footage of wells, then you're going to get an allowance from the underwriter, a discount for the footage credits, as opposed to somebody that's got maybe just one well with 10,000 feet. So it's just an economies of scale type calculation. Again, the limits are as per scale. They have a standard sort of load. If you come in at the $5 million amount, and then you just increase it depending on, if you go into 10 million, then they'll load it by another 15. If you go into 50 million, they'll load it. So there's these pre-formulas that are in place for that. The limits are an interesting subject, because the way that we like to look at things is that if you have a single standalone exploration well with an AFE, say, of $30 million, just hypothetically, the argument there is that you don't necessarily need to do your 3.5 times of the AFE. A standalone exploration well isn't going to really necessarily, other than things like Maconda, where you have bad things happen on occasion, generally speaking, would not necessarily require the type of limit that you might have, say, for a production platform that has maybe 24 slots, which basically means that you've got 24 wells that are actually coming out of this platform. If you had an incident on that particular production platform, even though it's not, it's producing, but you're not exploration activity, but if there was one incident, you could lose all those wells. So you have to think to yourself and talk to your friendly engineers here, what would it be to get that back to where they want to get to? So you might have a limit that is $1 billion or whatever, hypothetically, for that particular scenario. And we might only need a limit of, say, 75 million for a well that has got an AFE of 35. So, there's no real blanket type way of doing this. You have to look at each one in isolation and kind of work out what's best suited for that particular risk. Yeah. So you have lower pollution. Yeah. Just the one well to be redrilled, so why use the 3.5? Yeah. Why use 3.5, and why buy the seepage and pollution? Necessarily you can. I mean, if you can get it for nothing, then get it. But I mean, if you got to pay for it, then it makes sense to tailor make it for that particular exposure. Okay, so we were talking about establishing an exploration rate for the well. So hypothetically, if it's basically $5 a foot that the underwriters have agreed for the exploration well, then what you would generally do is your appraisal wells would be deemed to be 85% of the exploration wells, which makes sense. I mean, it's deemed to be not quite, you know what you're doing. You're appraising something that's already down there. So, you can still have a lot of things happen, but generally speaking, it shouldn't warrant the same price that an exploration well has. Your development wells are generally 80% of exploration wells because, again, Montara was a bad news situation, and that was a development well. But generally speaking, the exposure are less on that, so the underwriter would give you a credit for that. Ken doesn't look like he's going to, but I mean, generally speaking, they would. Workover wells are between 50 and 65% of the exploration wells. 50% if you've got a nice underwriter and you've got a big program. 65 if you're maybe in isolation and seeing someone not so nice. Not that I'm implying that's the case with any of you guys in here, but you know. Producing injection wells onshore would be roughly 15%, offshore roughly 20%. But you can do a lot better than that. We don't generally do much more than 10% on producing. But these are the addenda type rates that I'm talking about, and then you negotiate from there, yeah. Plugged and abandoned at between 5 and 7.5. Horizontal wells, and I showed you that slide earlier where the well just goes horizontally into the formations. They're a much more challenging type of drilling. In many ways they are, but from my experience on horizontal wells, they're so challenging that everybody's paying attention. You've got specialist drilling guys out there. Everybody's watching everything carefully because of the challenge that's associated with drilling them. So in many ways, they can be a lot less exposure there than a traditional sort of horizontal or vertical well, or not horizontal, sorry, a deviated or vertical well when half the people might be asleep or whatever. Don't quote me on that about sleeping. The sidetrack wells, you do sidetrack of existing wells. What that means is you might have your vertical well that's going down, and then they decide that they're going to, for a number of reasons. You could do it because you plug it, you twist it off and you left equipment down there. So you're going in and you're going to sidetrack around that particular area where you've lost your pipe. Or generally speaking, what usually happens is that they want to effectively do a deviation into a different part of the formation. So what you do is you'll charge the workover rate for the part that's already drilled. And then from there, for the part where you sidetrack off and start drilling, then you will do the full exploration rate. So you do 2 rates for the one well. Sometimes you can get lucky and not pay anything for the first part, but quite frankly, if there's a blowout incident or a well-controlled incident, then you're going to have to re-drill the whole thing anyway. So generally speaking, a premium being paid on a workover basis for that aspect is a fair result. Okay, so continuing with the rating, you've got your basic rate, which we established. You times it by your re-drill and your pollution loads and your cost of extra coverage is selected. So you've got your underground blowout, which we had that percentage established already. Evacuation expenses, which normally 15. Care custody control, which again is 15. Re-drill, which depends really on what it is, but it's generally about 15. And so you just do your established sort of base rate and just times it by all these different coverages, and you come out at your drilling rate. So it's a kind of simple calculation, drawn out sometimes a bit, but, and as I've mentioned probably 3 times already, and I'll do it 4 times because it's actually up on the slide right now, Addenda 44 is a guide and considerable negotiation occurs. Single wells are obviously treated differently because they're just one-off standalones, so they're actually quite difficult to actually get underwriters to write sometimes because, you know, if you have a limit of $50 million hypothetically, and a premium of maybe $1 million, then, you know, if something goes wrong, it's going to be a long time before you get your return back on that. So they quite often, you know, are more challenging to actually to broke into place. You also have batch drilling, which Cliff alluded to a little bit on one of his slides earlier, and that's basically cover for wells that are planned to be re-entered and or deepened and or completed at a later date. So you go in and you might want to, for economies of scale, you might have a drilling contractor there where you might drill just 10 wells in a row. And you don't complete them, you just plug them, suspend them, go on to the next one. Plug them, suspend them, go on to the next one. And then what you do is you come back later on and you'll re-enter them. So what the batch drilling cover allows you to do is to maintain cover for those particular wells when you go back in and re-enter the wells at a later date. You can do it either during that policy period or you can get an agreement to do it over the next policy period, because the control of well policy are all 12 months. But if you spud it on day 364, you still have cover for that well until it's completed. So it can overrun the actual policy period. And one of our friends here from Nigeria asked a question about re-entering. There's a lot of marginal fields in Nigeria. And the question that he asked yesterday was, what kind of cover do we get for that? And because the batch drilling endorsement is actually applicable for the assured that has the policy originally. So if you're doing it at a later date with, on marginal fields type thing with a new assured, which happens a lot of big oil, they don't, when a field is getting depleted, they move on to somewhere else. They're not necessarily good at the economies of scale on small stuff. That generally, you could argue that should, in a way, just be an appraisal well. You're re-entering a well, but you're appraising it to find out what you're going to go at. So there's lots of different sort of scenarios that are involved with that. So as Addenda 44, with its traditional methodology for calculating limit loads and for calculating limits, there's a new school of thought that's been out for a number of years now, actually, which is where they basically underwriters charge a rate on the AFE on a percentage basis. And the argument there, or the belief there, is that analyzing the AFE is a truer reflection on the risk exposure. And it has a truer reflection on how you would establish the limits and the rates. So quite often what they'll do is they'll look at the complexity of the well and the whole sort of well questionnaire in detail and just charge a rate on the AFE itself. And that actually, you can counter that quite a bit by again, maybe taking out non-recurring elements out of the AFE. And so that you can minimize, then you go in with an ingoing rate of AFE of 50 million, but if you take out some of the non-recurring stuff for mobilization and things, then you can maybe have that rate applying to a much lower AFE. It's quite a popular method of doing it. We try to avoid it as much as we can. Okay, so in conclusion, some of the issues that are onshore, the limits are generally purchased for offshore wells of between $5 million and $50 million, with deductibles of starting at around $250,000. Higher limits may be bought for deeper wells, and we've had a couple of cases where we've had requests for, $500 million for onshore wells and things like that, which, they were deep. In the end, we were able to convince the assured that they didn't really need a limit of that significance based on the information we had. But that just gives you an idea of some of the ballpark limits that are out there for insurers. So what are some of the dangers? Well, when you re-enter old wells, you potentially can have casing failures. There's been a large incidence, and we were talking about that a little bit, about insuring plugged and abandoned wells. A lot of operators don't insure them at all. A lot of them will insure them for 5 years, and then they feel that that's a satisfactory time, and then after that we're not going to insure them all. But there's been a number of cases of cement degradation over a period of time, and there's been a couple of instances of late, Rob might know more about this than I do, but of where there's been seepage and pollution elements on wells that were plugged 20 years ago, 25 years ago. So there's an argument for keeping that cover in place. Especially, it's just very cheap. Generally speaking, you might do, as I said, between 5 and 7.5% for that type of cover, and so it's not a lot of money necessarily for that peace of mind. But it's your own decision on that. So you've also got high-pressure shallow gas type situations, which have a severe frequency and blowouts. Underground blowouts can be very, very expensive. Oil spills, again, removal costs are very high. You have an inexperienced crew, then you end up having human error. One of the things about, when they talk about utilization on rigs, high utilization on rigs quite often means that there's a higher level of inexperienced crew. When the price right now, if you got money, now's a good time to get drilling contractors, because the drilling crews, because there's been so many kind of layoffs and redundancies across the industry because people just aren't exploring that much. The crews that are there are very, very good. I mean, you've got perhaps assistant drillers working as motorman or derrickman or even roughnecks. So the actual experience of the crews when there's not high utilization is very strong. So there's an argument for that way. Again, you have remote drilling sites which require, equipment and experts and high mobilization, demobilization costs, as I alluded to earlier. So what are some of the issues on offshore? Well, again, limits that are typically purchased are between 25 million to US dollars 1 billion. Sometimes more. There's been cases of risks that were being, offshore wells that were being drilled in Greenland a couple of years ago for Cairn Energy, and I think Petronas were involved with that as well, and they had limits higher than that. They had AFEs that are astronomical, but they were actually forced to, or told to by the Greenland government, that they had one drill ship that was drilling on, and they had a semi-sub on standby. So they weren't gonna, if there was a problem, they were gonna drill a relief well right away. They weren't gonna wait till someone came in. So they were actually paying $750,000 a day, I think, for the semi-sub, and $850,000 or whatever a day for the drill rig. And so that was hugely expensive wells to drill. So they vary, but in general terms, you see a range of between 25 million and $1 billion. So it's big numbers. Factors affecting offshore well control, well, I won't bore you.
Next slide.
Oh, thanks, Cliff. Yeah, factors, sorry, factors affecting offshore well control. Again, we talked about Macondo. I don't think I need to say too much more about that, but that had a huge bearing on the industry. And on one of the other presentations this afternoon, we'll talk a little bit more how that had a relevance in third-party liability, as well as limits. And again, pollution is a big issue now for oil wells. Again, the AFE and drilling unit costs are quite significant. The water depth and the type of units have a bearing on the costs associated with it. The well depths as well. The deeper you go, the more challenges you can come across. Has a lot of bearing on whether you have high temperature and high pressure as well. Again, the location of the well. Are you in a benign location? Are you in an area that is more challenging? Do you have mud volcanoes? Do you have, what are the geological sort of elements of it? Availability of the equipment. I mean, can you get things quickly? I mean, I remember when we first started doing risks in Myanmar, there was no infrastructure. If something bad happened, it was going to be a while before you had any sort of recourse from anybody. So, if you're doing a well in the North Sea, I mean, they're going to look at it. That's not going to be an issue because it's such a well-mature type area that the infrastructure is in place. So infrastructure has a huge bearing on it all. Where else am I hearing? Okay. Availability of equipment, yeah, the same thing. Seabed conditions, well, Cliff shows some good slides on seabed, and I think Paul did as well. And I mean, really, it's quite important because, especially with jackups, one of the biggest causes, I think probably the biggest cause of jackup losses are punch-throughs. And punch-throughs are basically when you put a matting down onto the surface of the seabed and you're jacking the rig down, yeah? And if you don't get it right, you just punch right through. And then so you end up with, bent legs and the whole routine. So seabed conditions are quite relevant. Again, weather conditions. Are you in a benign area? Are you in an area that's subject to typhoons? What kind of weather conditions do you have? And then just basic logistical factors. Those wells that we were doing in Peru were extremely challenging on a logistical front. Right. You're all hanging for a coffee, I can tell. Any questions? Justice? Oh, sorry.
Just a quick comment on the extended re-drill. When extended re-drill is necessitated?
Was that sorry?
Extended re-drill.
Yeah.
When it will necessitate extended re-drill?
Well, the extended one is, The extended redrill, again, that was the cover that you buy in the event that there is something that actually happens to the rig itself. Or so there's an incident that happens that is not a direct result of a control of well incident per se, but is a result of some external circumstance that made it impossible to sort of continue drilling because of an incident that happened outside of the control of well thing, so as such, yeah. So that's an additional add-on cover.
And on AFE,
Yeah.
is there any thumb rule ratio between onshore and offshore?
Is there any ratio?
Yeah.
Well, I mean, there's a lot of commonality on AFEs, but obviously there can be huge bearings on mobilization and demobilization on that. But I mean, I'm sorry I don't have it would have been nice to show you a breakdown of how an AFE is. It's quite comprehensive. It even includes insurance sometimes. But generally speaking, the format for the AFE is, you know, offshore is generally more expensive because everything's more expensive on offshore. The rigs are more expensive by a significant margin. And that part is part of the cost for the overall AFE as well. So generally it's much the same items that are included in there as a rule. There's always some different things, but generally it's the same. But it's just,
Logistics.
yeah.
I mean, the AFE is effectively the funding approval.
Yeah.
And drilling wells onshore and offshore, particularly offshore, is an expensive process. So the oil company are going to have sign off at a senior level that there's going to be approval for that funding for that particular well. So the correlation is really that onshore wells, because of the logistics, onshore wells are cheaper to drill. So the AFE, the funds necessary to drill an onshore well, are generally much less than the funds needed for an offshore well.
Would it be fair to say that an onshore well could be round about 5 million, a simple onshore well 5 million, a shallow water offshore probably 20, and a deep water offshore about 80?
Yeah, you could, but a lot of it depends where you are. Like in Sudan, for example, a lot of the wells there are only $5 million to drill onshore. I mean, it's not challenging drilling as such there. I mean, a lot of the wells now, as Cliff alluded to, you have EPS on there. You have to have your pumps down there to do it. So the AFEs there are quite small. But there are exceptions to the rule where we had some absolutely, well, that one that Nippon did was huge. But generally speaking, yes, around 5. Most of the offshore ones, it kind of depends. The reason that it's nice to see a breakdown in AFE is because sometimes the authorized final for expenditure doesn't include any completion. So they'll have an AFE for completion and non-completion. And so that has a bearing actually on the cost as well. If they're going to complete the well, it's going to be quite a few more $1 million on top of that. But yeah, generally it's